Today, we're going to discuss investing rules to follow for the rest of your life. Nowadays, investing has almost become a trendy word to toss around, and everyone has their own different motives for starting their investing journey. But too many times, a lot of beginner investors get burned because they focus a lot on trying to copy other people and doing what those people do, rather than looking at their own financial situations and realizing that your success as an investor is not only about what to do, but it's also about what not to do. Now, it is key to be mindful of the golden rules for investing. So let's take a look right after you drop a like down below, as it helps me know what sort of videos you like, so I can keep giving you more of that. Also, before we begin, we're assuming that you've already taken care of high interest debt and have set up an emergency fund. Now, if you haven't done that, then your focus should be on checking off those boxes before looking at any sort of investment. So with that out of the way, let's get started. Now, these golden rules are rules that you can take throughout your lifetime as an investor. It is easy to make money when the market is up, but when things get bad and your portfolio is getting beaten up, those who are able to succeed are the ones who have a plan and who stick to their rules. And you definitely want to be in the winner's circle, don't you? So let's get started. Rule number one is never lose money. Now, we're kicking things off with advice from arguably the greatest investor of the modern era, Warren Buffett, who said, rule number one, never lose money. And rule number two is, don't forget rule number one. Now, this can be unpacked into various lessons on its own. First off, it highlights the importance of avoiding losses in your portfolio, as losses take more time to recover. Now, there's a saying that goes, stocks take the stairs up and the escalator down, as gains take time to build but can be swiftly erased with the wrong decision. And taking heavy losses on your portfolio eradicates your future earning power. This saying also stresses the importance of risk management as an investor. To avoid losing money, you need to be great at managing risk to your portfolio. Now, this is not to say that you shouldn't take any risk, as any investment comes with an inherent risk. But a lesson here is to minimize the risk with sound decision making that is based on quality research. Look at the downsides of any investments and analyze it against the upside to determine whether the investment is worth it. Rule number two, start early and compound. Now, the key to building wealth is to start early, and the most powerful element of investing is time. Now, investing takes some time, but it's well worth it. As your investments grow, they will increase over time. The best way to think of it, it's kind of similar to a snowball that is rolled down a hill. As it keeps going down the hill, it picks up more snow and gets bigger. Now, this is how investments grow, especially when the received dividends are invested. It starts off slow, but progressively multiplies on itself. You just have to give it time. The best time to have started investing was a long time ago, and the second time to start investing is today. And when you invest, be sure to look for companies that offer compounding returns that you can take advantage of, like dividend growth stocks, for example. Now, if you're in Canada and you're looking for a brokerage to get started, you can use Wealthsimple Trade. Link is down below. If you click it, you get 2 free stocks. You're welcome. Rule number 3 to remember is invest like an owner. If a kid came up to you and said, give me 10 grand and I'll give you 20 grand later, most people will probably want to know what this kid does, where are their parents, and how they expect to grow that money in order to reach that goal. Unfortunately, that level of due diligence isn't being done by investors today. As an investor, you want to act like an owner because that is exactly what investing in businesses is. You're owning a minor share in the business that you invest in. Now, having this mindset means that you're interested in how the business makes money, how the management team has performed, the competitive position that a company is in, as well as factors that will impact the business ability to perform well over time. Nowadays, many investors treat stocks like gambling and tend to have a herd mentality towards investing. That is, they invest in something just because another person is doing it or their friend mentions it. But once you're able to invest like an owner and understand the businesses that you're investing in, including analyzing the fundamentals, valuation, and future growth prospects, then you'll be able to not only invest with confidence, but you'll be able to identify a greater number of investment opportunities that yield high returns. Now, just a reminder that if you're finding value out of this video, please drop a like down below and be sure to share this video with a friend. Now, let's go to our next point to remember. Rule number 4, understand what you are investing in. Like I mentioned before, don't just gamble your investment or throw money at an investment just because you hear it somewhere. Ensure that you understand what you are investing in and ensure that it is something that you can invest in safely. You need to understand why it makes sense to invest in something, and you need to factor in things like the track record and the risk to the investment. After all, it is your money. So before you head into your next investment, understand what you invest in, and if you can't understand it, it might not be the best investment to make. The next rule is buy when everyone is fearful. Now, when there's a down market, everyone gets into capital preservation mode, and the instinct is to sell before your holdings go down even further. This, my friend, is when bargains are out and you can invest with a margin of safety. Investing with a margin of safety allows us to purchase an investment that is below its value so that the investment can be made with minimal downside risk. So when the market is red, that is the best time to be screening for potential additions to your portfolio. Of course, this is easier said than done, but once you get over the initial fear and are able to have the resolve to purchase good businesses at a great value, you'll be well positioned for future growth. Warren Buffett has famously said, "Be fearful when others are greedy, and greedy when others are fearful." And this is exactly why. Now, if you're one that invests solely in an ETF or you have a 401k with your employer, then this doesn't really apply because all you have to do is keep buying whatever you are buying anyway. Next, let's talk about point number 6, which is to diversify. Now, unless you're solely invested in a broad market ETF, having only 1 or 2 equities is putting a lot of risk on your portfolio and is unsafe. It doesn't matter if your 2 equities have performed brilliantly in the past, because part of being a good investor is managing risk. And experts recommend that a well-diversified portfolio is a way to keep risk low. To build a well-diversified portfolio, you want to aim to have different classes of investments that will typically perform differently over time. Examples being stocks and bonds. And within stocks, you can diversify across sectors like healthcare, technology, and industrials, for example. Attaining this level of diversification helps to strengthen your overall portfolio returns while reducing overall risk. Now, if you don't have a preference for certain stocks or companies that you want to hold, the easiest way to diversify is to invest in an S&P 500 index fund. Tell me how many times you've heard this one. It's tried, tested, and true. Moving on to rule number 7, dollar cost average, or DCA. DCA means that you put in the same amount of money every month regardless of the state of the market. For example, if you aim to invest $150 to $200 a month for the next 10 to 15 years, this will definitely change your life. Dollar cost averaging means that you don't have to worry about what the market will do because you'll be automatically buying more when the market is up, and you also buy more when the market is down. And when the market is down, the same amount of money will buy even more shares since the price of shares will be at a discount, and after some time, they will rebound if they are good businesses. Simply put, if you always put money in the market, you will always get results, good results. And this creates the advantage of being able to weather the market conditions regardless of if it goes up or down. A good way to start with this is to set up an automatic periodical deposit to your investment account. It could be weekly, it could be monthly, whatever you think is best for your situation. Now, the best way to think of this is like payments that you're making from your present self to your future self. Studies have shown that over time, the market tends to go up, so putting money in the market will help you succeed in the long run. The best investors develop a process that is consistent, and they have pillars that they always adhere to in order to minimize risk and maximize returns. Holding on to these core principles helps to ensure that your investments align to your goals, and it makes you more of a savvy investor and less of a gambler. Thank you so much for making it this far. Now, if you found value out of this video, please drop a like down below. And if there's any other investing rules that were not covered in this video that you think are worth sharing, or if you have any questions, drop a comment down below as well. Once again, thanks for watching, and I'll see you in the next video. Peace out.